All right. Good morning, good afternoon, traders. Today is Friday, January 9th, 2026. This is You've Got Options for Income Navigator. Let's start off with this is the most recent trade that I put on. This trade was put on today. This is an iron condor, or I call this an iron bear trap. You call it whatever you want, but in a nutshell, this is a combination of two credit spreads, a put credit spread and a call credit spread. Call credit spread in this trade is 15 points wide, and a put credit spread is 50 points wide. If we look at the fills, and I posted earlier today that I put this trade on offering $9.80 credit, and there was no fill for a while. And I didn't forget about it, but I just let it sit there. And then I said, all right, what's happening here? The market started to pull back just a slightly bit. And I looked at the mid price. The mid price was at 985. My offer was at 980 with no fill. So I said, let me just cancel and replace. Same price, just refresh the order. And as soon as I did that, my order was filled for $9.80. But if we look at the prices that I got filled on both the put and the call credit spreads. So for the puts, I got 3605 minus 3120. So I sold a 50 wide for $4.85. It's a little bit higher than what I normally look for. I normally look for 50 point wide put credit spread for about $4, $4.50. So it's slightly higher, which means I could have potentially used strikes a little bit farther out of the money. I don't think it makes a whole lot of difference. So I just wanted to put credit spread around these round numbers. I've mentioned this before, and I say this time and time again, that I like to trade, especially for SPX, where I don't think that SPX options are illiquid, but you will notice there's a lot more open interest around these round numbers: 6650, 6625, 6600. So if I can put on the trade that I need to put on around these round numbers, that's what I will go ahead and do. So I sold a 50 wide put credit spread for $4.85. And then if we look at the call side, I sold a 7130 for 47.15, and then I bought 7145 for 42.20. So that is a 15 point wide call credit spread for $4.95. Combined, 495 and 485. This gave me a total credit of $9.80. That is the most I can possibly make in this trade. At expiration, if the price of the underlying asset remains between the short strikes of the put credit spread and the call credit spread, there's an implied probability of about 70% or so that we're going to be somewhere inside of the break evens at expiration over the next 42 days. There is a lot less risk to the upside, as you can see. Most and all of the risk is to the downside, right? Most brokers, most option friendly brokers will not require you to put up two margins to put this trade on. So having to put on this trade, the margin requirement is it's 5,000, right? Because our put credit spread is 50 points wide and it's wider than the call credit spread. So only one margin is required, which is $5,000. And that $5,000 margin requirement is reduced by the credit that we're collecting, $9.80 or $980 per one contract. So 5,000 minus 980 gives us a margin requirement of $4,020, right? That's what we have to put up with the broker in order to put this trade on. Now, $4,020 is our max. It's absolute max potential loss if we do nothing. If we don't adjust this trade, if we don't close this trade, just come back on February 20th. And if the price is below 6,600, we're out just over $4,000. That is not our plan, right? We have a profit target in mind, right? If I could get maybe half, maybe a little bit more of the credit in about half of the time, so in about 21 days, if I can get $450, maybe $500, I think that's a good exit. If we can get $300 profit in maybe 30 or 40% of the time, I think that's a good exit. Or if the market is really just going nowhere fast and you want to kind of, if we look at this trade and right, we can go out about 30 some odd days into the future, right? And this is projected. This is not exactly how it's going to happen because we don't know what the future implied volatility is going to be like, but we have to assume that if we're somewhere between 68.50 and maybe 70.50, right, with about 9 days until expiration, it's not very likely that the price is going to move outside of the break evens. So we could potentially hold for the remaining, whatever available credit is left at that point in time. But I think that if in about 21 days, if we can potentially make, $400-$500, I think that's a pretty good exit. Now, if we're going to make, $400-$500 on a good day, right, in a winning trade, are we going to really risk $4,000 if things go wrong? The answer is no. For me, I always look at this and say, look, if I could make between $400 and $500, right, and this is a pretty high implied probability of success in this trade, right? I'm not saying that every trade is going to work, but it's a pretty high implied probability of success. So if I'm most of the time, if I'm going to be able to hit $400-$500 profit, if things start to go the other way, right? If the market goes from, if you look at what S&P is currently doing right now, right? We're making a series of higher highs, higher lows. We're in a pretty tight uptrend, right? We're at all-time highs. Now, if we go from that to being more volatile, if the market starts to move outside of expected ranges on a day-to-day basis, clearly something is changing, right? And I probably don't want to be in this trade. I definitely don't want to risk $4,000. So I need to recognize that at some point in time, I need to use a stop to get myself out of this trade and preserve both financial and psychological capital. So what my stop is, if I'm going to make maybe $500 in a decent trade, right? I don't want to risk more than $500 or $600 if things start to get, out of control, so to speak, right? So I can look at where am I, let's go forward maybe a couple of weeks, right? So this is, again, we're not adjusting for volatility going forward, but in the next couple of weeks, right? Where am I down $500? Well, I don't really have to worry about the upside, right? Because to the upside, I can't lose more than $500 or so, right? All of the risk is on the downside. So where am I down $500 on the downside? Well, based on what this pricing model is forecasting, if we're down to about 67.10, right, I'm probably going to be at a drawdown of about $500. Also, if you notice, if we get down to about 67.10, we're also getting very close, right, to testing this part of our trade, which is the put credit spread, right? And we are outside of what is currently being priced in for the next 42 days. Right, so something has changed. The market is moving with more speed than what was being priced in. Implied volatility is probably rising. Right, so market's becoming less stable. We're very close to potentially testing the put credit spread of this trade. And I'm not going to wait until the put credit spread is tested only to look to roll the untested side. That's not what I do. right? Even though we do have a pretty decent amount of credit to make adjustments that will most likely be debits, I think the easiest adjustment here is just to get out of the way. Get out of the trade. Obviously, when we put this trade on, what's our near-term price outlook? Right? It has to be stable. We're taking a trade with a pretty defined range where we're going to make money. If the market starts to move towards either side of our break-evens, downside or on the upside, right? That means that the market or the price action is not stable, right? We're going from a pretty tight uptrend to a pretty strong trend, up or down. Right now, I made a note on Discord where I post this trade that if we break above about 70.50 or so, you can see that my delta in this trade at around 70.50 will turn negative, right? And if we are pushing through all-time highs at 70.50, do I want to hold on to a position that continues to accumulate more and more negative delta? Right? You could make the case why it's fine, right? Because the market doesn't only go in one direction. So if I do end up with some short delta on the way up, as soon as the market's going to revert back to the mean, that negative delta is actually going to play into my hand. So you can make the case for that, or if the market is just grinding higher, and we see that when market breaks above all-time highs, there's very little supply. Why would anybody want to sell at all-time highs? And I'm not talking about mom and pop with their 401ks. I'm talking about professional money managers. Markets pushing through all-time highs. Do you think they want to unload, only then having to explain why they're not participating to the upside? I don't think so. So it becomes very difficult to manage at times, right? Iron condors to the upside, they're a little bit more tricky, right? Even though we think that most of the risk is always on the downside, but in a market like we're seeing right now, I think the upside is a little bit more difficult to manage. It's difficult to manage because of the skew, right? If we were to roll or if we were to make adjustments, going farther out in price, if I was to roll this call credit spread, if I was to roll it farther out, right, the new farther out of the money call credit spread wouldn't have enough premium to collect to offset the cost of rolling this original call credit spread. So it just becomes a very difficult trade to manage. One way I would do it is maybe delta hedge, even though at 70.50 my delta just turns negative. There's really not a whole ton of exposure, but just to kind of hold things together a little bit, what I would consider doing is maybe buying a call debit spread, very narrow, maybe 5 points wide, where I can potentially rebalance and neutralize my net delta in this trade, right? But at any given time, if we are pushing with speed to the upside, I think this trade is very manageable. We can hold it longer just to see if and when we get reversion back to the mean. And if we don't, if we break outside of the upside break even, I would potentially consider closing this trade. Now, if you are trading something like this from a campaign point of view, like you can look at one trade that I have on right now. This is not it. Hang on one second. This is the standard bear trap that I would do with no upside risk. But I want to look at the iron trap that I have on. This is 7 days in. And in the last 7 days, S&P 500 has moved 1.3 standard deviations to the upside. And, volatility's, you could make the case that volatility is down a little bit in the last week, even though the VIX is kind of ticking a little bit higher. In any event, you can see that to the upside, yes, this trade is going to be at a drawdown. It's just how it works, right? The odds of some kind of a reversion back to the mean is starting to increase the higher we go, but it's not guaranteed. So you can see that I don't have as much risk to the upside as I do to the downside, but I have to be aware that at some point, if I'm down $400, $500, $600, I'm not going to try to fight it. I'm not going to try to make adjustments just to buy myself hope that at some point I'm going to be right. I'm just going to have to get out of the way. But now, if I put on another trade on top of this trade and kind of stack them, one on top of the other, right, they will kind of rebalance net delta, and you kind of want to look at all trades, right, in the same campaign together as one, right? So this one already flipped negative delta. As you can see, the higher the market goes, the more negative delta I'm going to accumulate. It's not a lot, right? There's not a ton of gamma, but it's definitely working against me, right? Right now, I'm short 2 SPX delta. If we move to 70.50, I'm down 2.5. I'm negative 2.5 SPX delta and so on. And if we push beyond the upside break even, you can see the delta goes from 2.5. And then it kind of flattens out because we don't have naked options here. So the risk is not unlimited, right? At some point, my net delta will start to even out, and the gamma delta is no longer my problem. My problem is that if we push far enough to the upside, now I'm outside of the structure. And if I don't do anything about it and the market continues higher or pulls back but doesn't pull back enough for the price to get back inside the structure, I have a risk of taking a max loss to the upside, which in this trade is about $1,000. And that's not my plan. Remember when I said that if at any given time, if I'm down about $500 or $600 up or down, I'm going to get out of the way and I'm going to close the trade down and I'm going to move on. Right? But stacking trades one on top of the other, look, so this trade was on last week. The market moved 1.3 standard deviations to the upside, right? So we're moving slightly more than what the market was pricing in this time last week. I put on another trade, which is delta neutral, right? And if we continue higher, both trades are going to continue to accumulate negative delta to the upside. And then if I'll put on one more trade, eventually, right, I'm putting on these trades, I'm diversifying not in different underlyings, but I'm diversifying over price, right? Because if I utilize or if I use similar or same structure, some trades I'm going to put on at 6,900, some trades I'm going to put on at 6,970. Maybe the next trade I will put on at 70.60. I don't know, but blended together, right? They all kind of have to work together. So if I'm going to put on the trade, say maybe next week, if the market's at 70.50 or 70.60, right? That new or the third trade isn't going to do well on the downside, right? It's not going to do well on the downside, but these two trades that I have on, one from last week and one from today, they have negative delta, so they'll kind of pick up the slack a little bit. Right, so you kind of want to look at your trades individually and understand where and when you have to cut risk, but together they also have to kind of build that picture that we're trying to build. Right, so that's the trade for SPX 42 days until expiration and Feb 20. Right, this is a monthly expiration week. There are two expirations, right? One is a monthly, one is a weekly, right? The weekly options are marked SPX PM. I just chose, there's no edge. I don't think there's a big difference, but it just so happened that the trade I put on today was in the monthly expiration cycle, which means that this trade will go until Feb 19, which is a Thursday, right? These options will stop trading on Thursday for Friday morning at the open for settlement. So whatever the open and print for SPX is going to be. That's going to be the settlement price, but I doubt that I'm going to hold this all the way to expiration. So that's why I say that whether you choose to go with the weeklies or the monthlies does not really make any difference. Let's have a quick look at the OG bear trap, or this is not an iron anything, right? Iron, what makes a trade iron is when we use calls and puts to put this trade together. In this trade here, we used all puts, right? This is a, I think this is a 10 wide. Yeah, this is a 10 wide put debit spread and a 50-point wide put credit spread. So these are all puts. If you don't want to call this a bear trap, that's fine. What this is an all put Condor. It's a unbalanced all put Condor, right? So this trade was put on 21 days ago. In the 21 days, we had the underlying go up about one standard deviation. So we're not seeing anything that is unusual or what was not being priced in 21 days ago. There are still 21 days until expiration. If you feel like you've had enough, and look, this trade could potentially be closed for maybe even money, meaning you if you put this trade on for $2 credit or $200 credit, you can possibly close this trade out for no additional credit and for no debit, right? You'll just get to keep the $200 and you'll avoid potential drama if the market should drop, 5, 6 or more percent over the next 21 days. Or if you want to continue to hold, right? What's the upside here? Well, to the upside, there's really no more financial upside, right? Because the farther the underlying goes up, right, the more all of these options will lose of their value. And eventually, when they all expire, they're going to all expire out of the money. This trade will be worth nothing. You will just end up with the original credit, which is what you could possibly grab right now and move on to the next trade. The only one reason you may want to consider holding on is that over the next 21 days, this darker gray area is what is currently being priced in, right? This is the expected move. If we move over the next 21 days, about 2 standard deviations to the downside, you have a potential to catch the trap, right? This is where the bonus is, right? At that point, at expiration, the 10 wide put debit spread is worth $1,000 plus the $200 original credit will get you a profit of around $1,200. The only problem with that is that if we move 2 standard deviations in 21 days, it's probably going to happen with some sort of speed. There's going to be emotions flying. The market's going to get a lot more nervous. So it's not going to be an easy trade to hold depending on how much time there would be. For example, if in the next 12 days, right, with 9 days to go, if we move down to about, right, 66.50, which puts us almost smack in the middle of this trap, it's a great place to be. The problem here is with the 9 days remaining, if we move down 5% in the next 12 days, you can bet vol is going to be, I don't know, the VIX is probably going to be in the mid-20s. So if we add, I don't know, maybe 10 points of volatility down to, right, 66.50, this trade is actually going to show a drawdown instead of being up as you would expect it to be, right? An increase in implied volatility is going to push our T plus 0 down. Why? Well, because implied volatility, right, if the VIX is at 20 with 9 days to go, expected move going forward for the next 9 days is actually pricing in a potential move outside of the structure completely, right? Beyond our downside break even. So there's risk, right? The value of this 50-point wide put credit spread is going to increase enough where the potential profit from the 10-point wide put debit spread isn't going to be enough to offset losses, unrealized losses of the 50-point wide put credit spread. That's why, there is no right and wrong. You just need to kind of consider your options, right? Because you have options to consider. What do you want to do now? You have 21 days to go. You can possibly close this trade for even money, right? And move on. Or if you want to play the trap, you're also running a risk of not just a 5% move to the downside, but if there is more downside follow through, right? You're not just risking the unrealized gain right now, but you can potentially run into trouble if the market is going to move down 5%, maybe consolidate for a day or two, and then continue lower yet again. So you want to consider all that. How do you want to go about it? If you want the easy life, right, you get out here and you just move on. Or if you have some kind of trades that would benefit from a big move down, right? Again, we all trade kind of similar things, but our portfolios, our goals, our risk profiles all different. So depending on what you have going on at any given time, you need to consider what is best for you. In any case, everything that we're talking about here is strictly entertainment and hopefully education for you. This is not a financial advice, so please be aware of that. All right. That's for these bear traps. I would probably look to put on another trade sometime next week. I really like to put these on Fridays. Fridays have 42 days expiration. And again, if you're going to do campaign trades at 42 days, if you're going to put them on every 2 weeks, in the 42-day cycle, you have 3 14-day cycles. So that kind of makes it easy to manage, right? You put on the trade, 2 weeks later, you put on one more trade, 2 weeks farther, you put another trade, right? So now you have 3 trades. And by the time it's time to put on trade number 4, trade number 1 will be coming off. Hopefully that makes sense, right? So that makes it a campaign. Every Friday, regardless, rain, snow, sunshine, we put a trade on. However, when it comes to putting on the trade, now we get to decide, right? What kind of trade do we want to put on? Do we want to put on a trade that has no risk to the upside because, maybe we think that the risk is to the upside right now rather than the downside? Or if you're more neutral, you say, you know what? The market is kind of neutral, right? I would be willing to take a little bit of risk to the upside and see if we can catch the price inside of some kind of a range over the next couple of weeks. Or if you're full on bearish, or if you think the market is due for a pullback, right? Maybe we're trading, 3 ATRs away from the 21 EMA. Instead of putting on the trade like what I did today, you can possibly look at putting on the trade that isn't 15 points wide on the call credit spread. And maybe you consider doing a trade that is a little more balanced, right? Putting on the trade where your call credit spread is not 10 points wide, but rather, what's that? 71, 30, 71. So 30 points wide. Instead of 10 wide, we do 30 wide. So we have a 50 wide put spread and a 30 wide call credit spread. You can see that you get to start off this trade with a net negative delta, right? So you have to decide, what do you need? Do you need positive delta? Do you want delta neutral? Do you want negative delta? And then based on that, you can make a decision how to set up your trade. But every Friday, 42 days until expiration, something has to go on because you have something that's already coming off. If you haven't, for example, if I put on this trade and then I take it off, at 21 days until expiration, then clearly I'm not holding it anywhere near expiration. But if I do a trade that looks like this, right, where there is no risk to the upside, I might hold it I might hold it until last day and let it all expire, which means that when this trade reaches 0 days until expiration, I will have trade number 4 that's going to be put on with 42 days until expiration. I see a question. What is the benefit of putting on a condor instead of an iron condor? That's a great question. Um, so let's just quickly talk about, right? This is an all put condor, and I'm buying a 10 wide put debit spread, and I'm selling a 50-point wide put credit spread. If I was to do this trade here, instead of doing this in all put condor, but to do it an iron condor, and I think that this is kind of a little bit misleading for a lot of people, especially newer traders that think an iron condor, you get to collect this fat credit. This is so great. You get this big infusion of cash right into your account, and this is how these unqualified furus out there are teaching these things. But that's not how this works. You don't just get the money. It's free money. It's yours to keep. Don't worry. That's not how it works. That credit that you're collecting just goes to offset some of that margin that you still have to put up a ton of money with your broker. But the reason why I go with one versus the other, not because I don't want this big fat credit, but because I want to trade options that are out of the money. If you notice, or if you go and take a look at even some of the most liquid names, once you start to go in the money, the bid-ask spreads start to widen out. There's a lot less demand for options that are in the money. So if I was to construct this trade using an in the money call credit spread, right? This call credit spread is like 3% out of the money. What would I have to do to convince the market maker to sell me this in the money call credit spread? I would probably have to give up a nickel or two, right? Maybe even more to get him to do this trade. I'm not saying that the market is rigged, but it's a lot easier, right, to find someone else on the other side of the trade when we're trading options that are out of the money, because everybody wants to trade things that are out of the money. There's more demand, there's more hedging activity, there's more speculation with options out of the money. So if I know that I'm going to construct a trade that will have parts or all options out of the money, I'm going to go with all puts, right? This is an out of the money put debit spread. This is an out of the money put credit spread. If I was going to use in the money calls to build this exact same trade, this is what I would have to do. And we're looking at 67.45, 67.45. Hang on 1 second. 1 second. Um, 67.45, right? 67.45 calls are 85 delta. So why would I want to go and sell a call spread that is so deep in the money? Can I sell it? Yes. But if you look at the bid-ask spread, right, there's not a whole lot of interest in trading these deep in the money spreads. But can I do it? Yes. Right. I would be selling a 67.35 and I would be buying a 67.45, which still puts me in the same structure. Right. Same exact structure, except my call credit spread is deep in the money, and I just don't think liquidity is great for deep in the money stuff. So that's why I choose to trade with options that are out of the money. Let's see. Question. So you are thinking every Friday or every other Friday, 1 week versus 2 weeks intervals to possibly put on the trade? Sure. I mean, you get to decide what works best for you, right? How many tranches you have in rotation. You can, if you're going to run a 42 DTE campaign and you're going to do it instead of every other week, which will put you at three tranches in rotation. If you do it every week, you'll have six. Can you hold all six, right? Maybe you scale down size and have six tranches, right? You'll diversify over time a little bit more. So you put on one trade this Friday, you put on the next Friday, you put on another trade, and so on and so forth. So you're diversifying over 7 days, right? Maybe the market stays in the same range in the 7 days, so you're not really getting too much time diversification and price diversification. But if the market starts to move around, right, you're putting on the trade today at 69.73. Maybe next week the market is at 70.50. The following week the market is, at 6,900. So you're putting on a trade every Friday. You get to put on a trade at different prices. So now you're getting diversification not only over time but also over price. Right, but the general idea, if you're going to do a trade every other week, in 42-day cycle, you'll end up with three trades in rotation, and then you just keep them rolling. Some trade ideas. I was looking at, if we wanted to get long, if we wanted to get short, or if we want to do trades that are neutral, we kind of want to filter out, right, our watch list, or if you're using a scanner, whatever it is that you're using. So I have a scanner for when 8 EMA crosses 21 EMA within last 3 bars, right? So in the last 3 trading days, 8-day exponential moving average crossed above 21 EMA, right? This is kind of a bullish signal, but you also have to look at the chart and figure out how bullish is it. Is it, are we still below 50-day, right? Is the overall trend still down and we're just now kind of getting a buy signal, which could possibly reverse tomorrow or next week or whatever? So there's definitely more digging that needs to be done, right? But in general, short term, when 8 crosses 21, this is a bullish signal. Maybe this is a signal that whatever trend is currently going on may be changing. And I'm going to give you an example for a trade that I would consider doing. And then, right, there are many ways we can possibly set up a trade. So I'm sharing, this is TradingView, and one of the first names, and I I sort my tickers in that watch list by price, right? Like I want the highest priced options, right? I think I prefer, stocks that are, $4, $5, $600 rather than stocks that are trading at $5, $7, or $10, right? Not, and sometimes you will find, $5 or $6 or $700 stocks that don't have a great liquidity. So you kind of want to be aware of that. But for the most part, right, when the Apples, the Amazons, the Teslas, when they were Netflix before the split, right, before they split, even though they were higher priced stocks, they were still very liquid, and it doesn't take as many contracts to put on some size. So that's why I prefer to look at higher priced stocks first, and then I go down the list, and then anything below $50, I don't really have much interest there. So one of the first things that I saw on this list, and it's here now, it's not, it's here now, it's not, so it's kind of coming on and off my watch list, is Costco, right? COST. And this isn't a name you probably heard about in recent months. Why? Because it's been in a very steady downtrend. When it was in an uptrend, every furu and their mother on YouTube loved this name, and then they got caught holding a bag here. Haven't heard from it since, but now it's starting to caught my eye. Why? Because 8 and 21 crossed bullish a couple of days ago. right? So you can see that 821 has been in a bearish formation for quite some time, right? This is going back to, I would probably say that, this is going back to June, right? When 821 crossed bearish, and then we just went on to make a series of lower highs and lower lows, right? This is what makes it a downtrend. And then you can see that the price tried to break above these moving averages. And I'm pretty sure there were signals along the way where 8 crossed 21 to the upside, but it didn't stick. And I'm not saying that this is it, that, just because we had an 821 bullish cross, this doesn't mean that, we're out of the woods and this thing is ready to go. But this downtrend may be shifting. So, right, what are we looking at? We're looking at 821 cross bullish. We are above 50-day. That's also bullish. We have MACD's cross to buy signal. Right, we're now starting to get above the zero line, right? Kind of confirming potential trend change. Right. So now from here, we want to see, we kind of want to pay attention to a couple of levels here, right? So the 946 or so up to 956, right? This is where we ran out of buyers back in October. Looks like we were able to take out, right, this previous lower high from earlier in December, right? Volume, I wish, the volume was a little bit more optimistic, but it is what it is. So we're talking about a $925 stock, right? Are we going to go out and do what? What are we going to do with this? Are we going to sell a put? Right? If this is a bullish setup, what are we doing? Are we selling a put? Are we buying a call? How do we play this? Well, let's consider some ideas. Sure, we can sell a put. Where do we sell a put? I don't know. You could sell a put right here, 940. Right? If we break below this recent lower low, this means that this trend is still down. You don't want to be in a bullish trade with a stock that's making lower highs and lower lows. So you can kind of define your risk. You sell a put underneath most recent support, right? Maybe it's 840. The problem is if we go through 840 and you don't stop yourself out, at 840, if you get assigned 100 shares, you have to put up $84,000. Now, if you can do it and you'll be willing to do it, no problem, right? There's no right and wrong. But you got to consider this, right? These higher price stocks, right? How much capital are you going to commit? And if you are going to commit, if not, where do you put your stop, right? How much are you going to risk? If it breaks 840 from 925, what's your P&L like, right? And you can size your trade from there. So that's one potential idea, right? You can also play, you want to get bullish exposure, but you don't really want to put up $84,000 to do it, right? We can do something that looks like a poor man's covered call. And okay, poor man's covered call has two components, right? We have the stock replacement. We're not going to buy the shares at 925 and put up $92,000. We're going to go and take advantage of the leverage that the leap options will provide, right? We'll buy January 2027 in the money call. That's going to be our stock replacement. And against that call, we can look to sell, at the money, slightly out of the money calls, right? To generate short-term income while we're holding on to a longer-term in the money call, looking for longer-term capital appreciation. Hopefully that makes sense. So now we can look at, right, what does that look like? And I'm going to switch over. Dean asking if it's an 80 delta. It's a great question. And I'm going to show you exactly what I'm looking at. And I hope that you guys are going to use a similar process. I'm not saying that this is it, only it, but kind of what I look at. I'm going to share a different screen. So what I look at a effective leverage, and just in general, right? Like if I'm going to buy a leap in Costco, January 2027, right? 371 days out. So I looked at different strikes, and we can, let me pull some, more information. We could compare and understand what do all of these mean, specifically effective leverage, right? Because Costco is, it's not a super volatile name, right? Implied volatility right now is right now, looking at the option statistics, it's currently trading at a 4% IV percentile. And the implied volatility for Costco right now is 19%. So it's not super volatile name. But if we are going to look at different options that we're going to use as stock replacement, let's look at, right? So I put up, the first one I put up is a 660 call, which was, I mean, this is just a little bit earlier today, but it was going for about $297. Let me just double check. 660 right now is going for, well, the mid is 297, but if you look at the bid ask, it's 293 bid by 302 ask. It's pretty wide. Why? Because it's deep in the money. There's not a lot of interest from the market participants to trade these deep in the money options. And this goes, you know, towards the discussion we just had about, choosing options that are in the money or out of the money. But so if the mid price, if the mid price between the bid and the ask is about 297.50, right? It's close enough. We're paying $265 of intrinsic value. This option has real value, right? It's in the money. It has real value. It has time value, $31.30 or so, right? What does that mean? Well, we're doing a trade. We're buying a leap that has 371 days until expiration. This time is worth $3,100. And if we compare, right, how much intrinsic we have relative to the price where this option is trading, almost 90% of this price is intrinsic, which is good, right? We don't want to buy a bunch of time premium because, as we know, the time premium is going to decay over time. Even though with the leaps and 371 days out, that decay is going to be very small, but it's still, right? It still has the potential, and we are going to lose this time value unless the underlying starts to move up, and intrinsic from that move up is going to replace the extrinsic. If we buy this option right here, right now, and the stock doesn't move, well, guess what? Intrinsic isn't going to increase, and the extrinsic is going to go to zero over a long time, right? So that's why decay initially is very slow. So we kind of want to understand how much intrinsic we're buying, how much extrinsic we're buying, right? Anything about 85% intrinsic, 15% extrinsic, I think is fine. If you're going with 50% intrinsic, 50% extrinsic, it's not wrong. You're just exposing yourself to potential losses of that extrinsic value unless you are really, really good at timing the market when the underlying is going to move. But if you buy a leap, right, 370 days out, and the underlying doesn't move for the first 2 or 3 months, your extrinsic is going to get hit hard, right? And now you need the underlying to move faster than it before to compensate for the loss of that extrinsic value. Hopefully that makes sense, right? So there's no one right, everything else is wrong, but we kind of want to understand how much and what we're paying for. So of the 297, 90% of this is going to be intrinsic value. About 10% or so, it's going to be extrinsic value. I think that kind of passes the test. Delta for this call is about 90. Don't ask me why is it 90 on Schwab, why is it 92 on Tasty? It doesn't matter, right? You can take whatever you do, just be consistent, right? Don't just grab data from where it works better for you or the other way. Just be consistent. If you're going to use data from Schwab, then stick to all data from Schwab. If it's going to be Tasty, then stick to Tasty. But I see that on Schwab, it's delta about 91, so maybe it's about 90 delta. Right, and now we're looking at the cost of this exposure, and then we're going to figure out what our effective leverage is. I did a video on effective leverage. If you want to look at it, you can go on Discord, go in the search, hit effective leverage. You'll get one of these You've Got Options segments where I spend probably an hour just rambling about effective leverage and explaining exactly what it does and how to use it. But in a nutshell, effective leverage tells us how much we are expected to make or lose in the percentages terms for every 1% move in the price of the underlying asset. What this 2.8 effective leverage means is that if the underlying goes up 1%, this leap is going to go up 2.8%. And it works the other way as well. If the underlying goes down 1%, we're going to be down on the sleep about 2.8%, right? So you kind of want to understand your notional leverage, and you will see that. Let's do this real quick, right? Last price. We're going to use the exact same expiration cycle, 371 days. But let's look at options that are not as, we can't call them expensive. They're not expensive. The vol is 19 right now, and I would make the case that Costco's options are not expensive. They're in the money options, just higher priced, right? So if we didn't want to put $30,000 into this trade, say we only wanted to do half of that, right? 15,000. What can we buy for about 15,000? And that would be 840. So instead of 660, we're using an 840 call, which is currently going for about 156. And then we're going to let our spreadsheet figure out what the story is. The delta for the 840 is around 73. This will figure out cost of the exposure, right? Lower cost, higher leverage. Now you can see that if we go with the 840 call for our leap, we have to put up less money, which means we're paying less intrinsic, we're paying more extrinsic, right? In relative terms, we're paying less extrinsic, less intrinsic, and we're buying more of extrinsic, right? They're about 50-50. So half of this $156 is going to be intrinsic, and the other half is extrinsic, right? So we're exposing ourselves. If we are not good at timing the market, right? If Costco's going to kind of go up a little bit and then down a little bit, and then we spend 2 months just doing absolutely nothing, this extrinsic value is going to get hit. And if you don't figure out a way to compensate for it, this could be, a bit of an uphill battle from here. And you can see that, leverage is a great thing, but it works both ways, right? It can work for you, it can work against you. Effective leverage here is 4.3. What does that mean? That means for every 1% move in the price of the underlying, this leap is going to move just over 4%, right? So you're kind of getting, I guess you can say it's a 4-to-1 leverage here, right? So if the underlying goes up 10%, you're going to make over 40%, which is great, right? Because you only have to put in so little money, right? So your return relative to how much money you have to invest into this leap is going to be significant. in the percentages terms, right? But if the underlying goes down 10%, you're also going to lose about 40% of the price of this leap, right? So you have to kind of go through this process and figure out. I don't think there is one that works and everything else doesn't. It depends how much leverage you want. If you'd be willing to put a little bit more as an investment up front, but get exposed to less of a market whipsaw, yeah, maybe that works better for you. Maybe you're saying, you know what, I'm going to wait and I'm going to use a very tight stop. I'm not going to let this thing go down 10% without having, to do something. Then you may want to go with options that have a little bit more of an effective leverage, right? So if you were to do something like this, and let's just draw this up real quick, and then I'm going to let you guys go. I know that it's Friday and you probably have better things to do than to sit here and listen to me rambling on about. Let me share a different screen. And so this is let's go look at Costco 371 days. So we're going to look at calls. We looked at 840 and we looked at 660. So let's take a look at 660. I would probably choose the 660, not because I just don't really want to have as much effective leverage just yet, because I don't think that this breakout is, and I think it's a little too obvious. They're probably going to be a shakeout, right? But so I would rather put in a little bit more and have a little bit less of a whipsaw, but and paying more, I'm going to try to also figure out ways to recover, right, as much of my investment as possible. So I would be looking. So this is the leap, long leap, right? You got to put up about 30,000. Considering how much extrinsic we're paying, our upside break even is 958 and change. I would then go and look to sell a covered call against this leap, right? You can go 35 days. It doesn't have to be anything fancy, right? Stocks trading at 925. How do we choose which call to sell? Do we sell an at the money call? Do we sell an out of the money call? Right? You kind of want to, look, you can use filters, right? If the stock is bullish, you go farther out. If the stock is neutral, you go at the money. If the stock is not bullish and not neutral, you probably shouldn't be in the trade to begin with. But let's look at, right, we're at 925. We think a breakout is going to happen, or maybe there's some follow through. So maybe we'll go with something like a 35 delta. Right? This is no different than buying stock and selling a 35 delta. This will get us about a 54 delta worth of net exposure in this trade, which means that for every 1 point that Costco goes up, we should expect to make about $54. Same thing on a downside. Costco goes down a point, we should expect to lose about $54. Right? That's clear. And if this breakout does take hold and there's some follow through here, right, we still have positive delta. We're going to start to lose positive delta on the way up. So kind of want to be aware of that, right? This is a bullish trade. This is a bullish trade, no matter how you slice it, because we have positive delta to start. But then as the underlying starts to go up, we're going to lose some of that positive delta, and it could work in our favor, because after a move up, maybe there's some back and fill, right? And if that is going to happen, I would rather have less delta when the market's going to pull back a little bit. And I know that once we push far and on, even if that 950 goes in the money, I don't really care, right, if the market's going to go up or if the market's going to go down. I just don't want it to go down a lot, right? So if we're going to go up and then just kind of back and fill, back and forth, and just do a whole bunch of nothing, no problem, right? 28 days later, I could sit on this trade and it can be slightly lower or slightly below our short strike. It all works for us. We just don't want to see a big move to the downside. That's why we have to keep one eye on the chart just to see if the chart is still telling us the story why we got into this trade in the first place. We can do that, or we can do, if you're not certain and you say, you know what, maybe I'm going to start off with an at the money. Right. An at the money call gives us 37 delta. So less than 54 delta. We were just looking at using short calls at 950. You get a little bit more room, right? You get your downside break even is a little bit farther out, right? It's all great. But it works very similarly that on the way up, we're going to lose some of our positive delta, right? And it's okay that our short call goes in the money because, look, then we need to figure out what are we doing, right? Are we going to roll this call? How far? How many days until expiration? Or do we want to just kind of reset the whole thing, right? Reset the whole trade. We can do that as well. One other way we can do this trade is, again, we're just looking at different ideas for a short call against our leap. We can do an overwrite where we're effectively long 90 delta with the leap, and then we'll sell two calls that are farther out of the money. Kind of similar to the first option that we looked at, right? We get the net plus 50 delta to start, which means we should expect to make or lose about $50 for every 1 point move up and down in the price of Costco. We have a pretty good potential if we were to push to about an edge of the expected move over the next 35 days. Again, we don't really care about the upside as much, even if our short calls go in the money, right? Our upside break even is over $1,035, which is, about 12% or so out of the money from where we're trading right now. We're really concerned about being wrong, right, initially, and the underlying going lower. If the underlying is going lower, well, now you don't want to let your ego do the driving. You need to look at the chart and say, hey, what's happening here? Is this downtrend continuing? Right? Because we're considering this looking for a trend reversal. You can see how many times 8 came to 21, crossed possibly bullish, and then it didn't follow through. So can this be another fake out? Maybe. Right? So if you want to kind of start with a trade like this, or even better, you can say, you know what, I'm not going to do the 980s. Maybe I'll do two 940s or maybe 950s, right? Give myself a little bit of room. And if we could possibly close above 950, maybe 960, right? This trade may be at initial drawdown initially, but then it'll auto correct itself over time. I can show you what the projected T plus zeros will look like. If we rally to 960 today in this trade, right? This trade would be at a drawdown. This red line represents T plus 9. This is 9 days into the future. If we're at 960, but 9 days from now, this trade is going to show a profit. Okay, so it's not really that big of a problem. The big problem here is that, we get some kind of a stupid move, 10% in a 1 or 2 week time frame, and yes, the risk to the upside is real. Or I don't know, somebody comes in and says we're going to buy out Costco at $1,200, and then we have a real problem on our hands, right? But near-term risk up to a certain price level is not all that great. And then if we are going to slowly find more buyers to potentially, right, make a run to $1,000 or so, right? Now we have to figure out how to deal with our options that are now in the money, Right? Sounds scary, but it's not, because we can buy to close these 950s, roll them out for more time and maybe up slightly, right? Maybe there's a credit there, maybe there isn't. If there isn't a credit, right? If we cannot collect the credit on that roll, well, guess who's going to pay for that debit? It ain't going to be me. I'm going to go and look at my leap, which means that if underlying is rallying, that's causing near-term heartburn with these short calls, well, at least my in the money call is picking up some of that slack. So, which means that if I have to roll my calls up and out and there's a small debit or whatever that debit may be, I need to now roll my leap up to collect the credit, and that credit is going to go towards paying the debit to fix our short calls. Right, so these are just ideas. I mean, I hope that this gets you to think a little bit more about these trades and these structures. I don't think that one is better than the other. You kind of want to understand what options you have. You can buy a leap, sell an at the money call, buy a leap, sell out of the money call, buy a leap, one leap, sell two calls at the money, out of the money, far out of the money. Kind of want to compare risk graphs, understand where your risk is, and have a plan of what you're going to do if whatever, up, down, sideways, and so on and so forth, right? Hopefully this kind of gave you something to think about, maybe over the weekend. If you have any questions, do not hesitate to ask, please. Your questions are always welcome, and I will see you guys next week. If you need me, you can find me on Discord. Have a good weekend, everybody. Take care. Bye-bye.